Good morning. My name is Gad Lebanon. I'm Chief Economist North America here at the Conference Board. And welcome to our September edition of Economics Watch. Today we're going to discuss economic conditions as usual in the global economy and the US economy. And we'll give you also a sneak preview into 2019. While the current economic conditions are pretty good, in 2019 we are expecting to see some slowdown in the US and also outside of the United States. And that's the main thing that we will discuss. Some of the questions here that we'll discuss, there are already some signs of slowdown in Europe and emerging countries. What can we say about that? The US monetary policy is becoming tighter as the labor market is getting tighter. And what implications will that have for the US, but also for the rest of the world? We'll discuss the current strengths of the US economy, and then we'll move to 2019 and we'll ask whether the fact that global growth is no longer as strong as it was in 2017 and earlier in 2018, would that impact the US, and what is our forecast for the US in 2019, and how is the higher interest rates going to impact investment behavior in the United States. So a lot to discuss. I just wanted to remind you, for those who are interested in CPE credits, that they are available. You just need to type your full name and email address in the space provided. Click OK for the 3 pop-ups that occur during the program. And credit is available for participation in the live webcast only. Together with me in this webcast, as usual, Brian Shaitkin, a senior economist for the US. Welcome, Brian.
Thank you, Gad.
And in our Brussels studio, our senior economist for emerging markets, Abdul Rumban. Hi, Abdul.
Thank you, Gad.
So we're going to start as usual with the global outlook, but before we are going to tell you what we think, we want to hear what you think. So we have a poll question that the studio is going to put up in a second. So the question is, what's your company's level of concern about risks in Turkey and Argentina spreading to other emerging market economies? High, medium, low, non-existent. Again, the significant deterioration in Turkey and Argentina. How much is your company worried about this spreading to other emerging market economies? So let's wait a few more seconds. 5, 4, 3, 2, 1. And let's close the survey. So very few of you think that it is high or non-existent. So most of you think that it is has some impact, but a significant majority thinks that this is a low risk. Abdul, Brian, do you think the low risk is indeed the case?
Yes. The global economy has changed a great deal since 1997. Market participants are better at assessing risk in individual emerging markets rather than simply assuming that all emerging markets are connected based on a series of factors. Now, there are some factors, as we'll get into, tighter Fed monetary policy, a rising dollar, higher oil prices, that will affect certain types of emerging market economies beyond just Argentina and Turkey. But I think in terms of having a synchronized global emerging market risk, the probability is low, as our audience correctly identifies.
Abdul, any thoughts on that?
I think I would agree with that as well, because I think the main effect of this crisis would be hampering sentiments in emerging markets among the investors. And a wider impact on emerging market economies is very unlikely to happen. So as Brian rightly said, some economies are vulnerable indeed, because especially those economies which have large twin deficits, the current account and fiscal deficits. So those economies will be a little vulnerable. But overall, I think the crisis will be more of a kind of a banking sector exposure, and especially in some of the European banks, like from Spain, Spanish banks and things like that. So the wider emerging market impact is very, very limited, I think, as such now. But it can, of course, significantly hamper the sentiments in these economies.
Thank you, Abdul. And so our expert's conclusion is that by itself, Argentina and Turkey are not enough to really destabilize emerging economies, but there are a lot of other things going on which make us a little concerned about emerging markets. So, Abdul, why that is the case, and what's the overall outlook for the global economy?
So the global economy is continuing to perform reasonably well at the moment, but the point is that we are expecting the growth to be easing down, because we know that the United States is performing relatively solid growth, and it has been strong for a while now. However, we see continued weaknesses in some of the emerging market economies, and also we see weaknesses in European economies, in Euro area. In the emerging markets, China is seeing some weaknesses, but particularly in Latin American economies, Brazil and Mexico are seeing significant weaknesses lately, which is going to hamper the emerging market economic outlook. India remains resilient so far, but it has its own significant external challenges, including rising oil prices, which can hamper its current account, already weakening current account deficit, and it can also hamper inflation. And in India, we already see a capital flight is happening, because since the beginning of this year, we have seen a $7 billion worth portfolio investment coming out of India, so going out of India. So this will also hamper, I mean, sustaining the current growth momentum will be difficult for India. So overall, the emerging market economies, we see a significant weaknesses. In UK, there has been some uptick lately, but that was primarily driven by a boost in retail sector, which was supported by an improved consumer confidence. Manufacturing sector in UK remains weak and significantly weak, actually. So going forward, we see fears of recession coming along in UK as well. So Europe as a whole is seeing significant weakness. So overall, what our conclusion is that even though there is the growth, the economy continues to perform reasonably well at the moment, the growth will be moderating, or it will be easing in going forward.
Thanks, Abdul. I think that the rest of our presentation about the global is focused more on emerging countries. So maybe to say one or two more words about the UK economy. We are, I guess, more concerned than most analysts at this point about a recession in the UK, which is a lot depends on political factors and what kind of a Brexit we will end up seeing. Brian, Abdul, and any kind of additional comments you have on the UK situation?
I think from a UK perspective, our LEI has clearly been signaling that the probability of recession is rising in the UK. And I think a lot of that does connect back to uncertainty around what kind of Brexit is going to happen, whether it's going to be a hard or a soft Brexit, what the particular dimensions of that Brexit is going to be, and will there even be a final agreement, and how are key business players going to react to that? So I think there's a lot of uncertainty. Uncertainty does not build business confidence, and that accounts for a lot of the current concern about the UK economy.
Right. No, thank you, Brian. That's certainly something that we recommend our viewers to put emphasis on. We are probably more than most analysts and forecasters are concerned about a potential UK recession. Abdul, what about in general, what are leading indexes showing at the moment?
Yeah, so here you have the leading economic indexes for the emerging market aggregate along with the global economy on the left-hand side. And on the right-hand side, you have the major emerging market economies, China, Brazil, India, and Mexico. And what you see is that the black line on the right-hand side, you see that the China is showing some weaknesses. So China has been showing an increasing trend in the 6-month average growth rate of leading economic index, which has now declined. And more importantly, what you see is that Brazil and Mexico, the green and yellow lines on the chart, which really show significant declines, and they are in the contraction territory, in the negative territory, which is significantly suggesting significant weakening in Latin America in general. So India is the only country that shows a marginal uptick in the leading economic index. But as I said earlier, India has severe macroeconomic challenges, and because its macroeconomic prudence is at stake, as the current account deficit is widening and the currency is falling. Indian rupee has hit the lowest all-time low in the last couple of weeks in the context of a strengthening dollar and rising oil prices and so on. So inflation fears are also mounting in India. So as of now, we are not expecting India to weaken its growth rate, but we think that it will be hard for it to maintain the growth momentum further. So overall, with the significant risk around rising oil prices, a high borrowing cost because the falling currencies are making I will show that in a minute. The falling currencies are making it difficult for these countries to service their credits, and fears on global trade war and so on. All these factors are playing a significant role in weakening the emerging market outlook, and so we see a possibility of moderation in emerging market outlook in the rest of the year.
Abdul, so we know that Argentina is in a real crisis, and here the LEIs for the leading indexes for Brazil and Mexico are also in negative territory. So what's causing this weakness in Latin America?
Yeah, so there are a number of factors that are playing a role here, because in Brazil, of course, Brazil has been recovering from its recent recession, but then lately it had a significant truck strike, which has halted the entire country, that has caused significant drop in its economic activity. And inflation has been a major concern, and also which was not a concern in Brazil for a while, but now that also has started moving up. So significant weaknesses in its industrial sector is also contributing to the weaknesses in Latin America. So overall, I think along with the continued weaknesses in Brazil and Mexico, which is also corroborated by the political uncertainty, because Mexico's recently elected government, it is still unclear how the policies are going to shape there. And Brazil is going to have an election next month, which is also adding significant political uncertainty there. So all these factors are playing around significantly here, and which, along with the significant crisis in Venezuela, and now the added crisis in Argentina, all are adding together to an extremely weakening Latin America in the coming months.
Thanks, Abdul. And in general, exchange rates in emerging markets are not having a good year, in some places more than others. What's behind that?
Yeah, so the bigger discussion at the moment is, of course, as we have seen, that the financial vulnerability in Turkey and Argentina, and also to some extent South Africa. So as you can see here in these charts, the currencies in these countries have been extremely volatile, and it has been losing significantly in the last couple of months. So, for example, in Turkey, its currency has declined, lost its value by more than 35% since the beginning of this year. And in India, even in India, it has lost by 11% since the beginning of this year. So what is causing it? In the case of Turkey, so there are several domestic policy mistakes, a loss in the confidence in the current administration, management of the domestic economy, significant fiscal stimulus, which has caused high inflation, and widening current account deficit. And also its extreme dependence upon foreign funding for servicing its government and trade deficit. So all these factors are playing around. And along with that, we have the strengthening dollar in the United States, rising interest rates in the United States, which is causing capital flight from many of these economies. All these factors are playing a significant role in weakening currency in many of these emerging market economies. As I said earlier, when we were responding to the poll question, so this may not have a larger impact on wider emerging market, but still it can have a significant effect on banking sector. For example, in some of the European banks, for example, like Spain, France, and Italy, these banks have significant presence in Turkey. Also, some of the Eastern European countries might be affected. So at the moment, the banking exposure is the biggest exposure to the crisis in Turkey and also in Argentina. But the issue is that this can hamper sentiments in emerging market economies, which can lead to a kind of wait-and-see approach by investors, that they will avoid taking risk and investing in countries where currencies are weakening. So also they may pull out money from the economies where currencies are weakening, especially countries like Indonesia, which has very high exposure to foreign debt, and also countries like India and Indonesia, where current account deficit is widening and large current account deficit. So these countries are vulnerable. I mean, they have not affected significantly at the moment, but they are vulnerable to capital outflow because of fears of sentiments. And if the negative sentiments outpace a kind of more cautious approach, wait and see approach, this can worsen the situation further.
Yeah. Thanks, Aldo. And the decline in as you mentioned, the decline in currency is especially risky for countries that have a lot of their external debt denominated in foreign currency.
Yeah, that is true actually, because many emerging market economies have high external debt. And in this chart, I have picked only the countries which have high external debt denominated in foreign currency, which will make it difficult for these countries to repay their debt, because the value of their currency is declining. So Turkey is, of course, at the top of the list, because it has a very high foreign denominated external debt. So 35 to 50% will dominate foreign denominated currency debt in Argentina and Turkey, which is significantly large. 35 to 50% of their GDP, so which is very high. I mean, even other countries are also not spared. Actually, they also have relatively large foreign denominated debt. So what happens is that when it becomes expensive for them to repay their debt, the implication of that is that a reallocation or the misallocation of resources from more productive investment to repaying debt, which can have both short-term and long-term impact on their economic growth and outlook. So this is a bigger problem at the moment for many of the emerging market economies, as their currencies are falling.
And what's happening with the currencies development? What's happening to inflation?
Yeah, so it is also, it's in addition to the issues which we are talking about, that is the strengthening dollar and rising interest rate and capital flight. Another dynamics that is happening in many of these emerging market economies is rising inflation and rising pressure on inflation. Basically, on the one hand, oil prices are remaining high, which makes it the import expensive for so these economies. And many of these economies, emerging market economies, are net importers of oil, and that makes their current account further worsen. So the combined effect of the oil price increases, which rises the cost of production in emerging market economies, which lead to cost push inflation, And then the weaker currencies makes their exports cheaper and imports expensive, which again adds to inflation. On the one hand, it adds to the prices, purchasing prices by making imports expensive, but also it makes since the export becomes cheaper, so that accelerates the production, but that is good thing on the one hand, but still it can also have an inflationary effect. So at the moment, inflation is already very high in Argentina and Turkey. Turkey it's about 17%, and in Argentina it's about 31%. And other countries are also showing inflationary tendency. So I think inflationary pressure is mounting in all these emerging market economies with their weaker currencies and rising oil prices. So this will be another challenge and for these emerging market economies.
So I think the bottom line is that there are a lot of countries in the world. In 2017, we were lucky that almost all of them, with the exception of Venezuela and maybe 2 or 3 other countries, all of them were in a pretty good economic condition. Part of it was luck, because when you have so many countries, you'd expect bad things to happen to some of them. And in 2018, it seems like bad things are starting to happen to some of them. It's still not across the board, but in certain important countries, we are definitely seeing major weaknesses, which is, probably will lower overall economic growth, because the synchronized growth that we had in 2017 was to a large degree a result of the fact that in almost every part of the world there was solid growth.
Yeah, that is true. Yeah. So especially the thing is that some of the larger economies within the emerging market economies are now seeing a kind of weaknesses. So that can add to the overall emerging market weaknesses.
Right. So as some of our viewers know, we started releasing our global consumer confidence index in recent months. It's a measure that asks the exact same questions across many countries. So, Abdul, what is the main message from that survey for the second quarter?
Yeah, so the main message is that so far we have been talking about a lot of negative things, but there is something positive about this. Some of the, at least about the larger emerging market economies, particularly India and China, which is that consumers are still confident about their spending intentions, their income, and also their job prospects in many of these economies. So overall emerging market economies show a marginal decline in consumer confidence index. However, it still remains above the optimal territory of 100, and so which suggests that consumers will still support growth in some of these economies. The negative side within that is that it is again highly concentrated in some of the economies like India and China, while many other economies, also some of the economies in emerging market economies in Europe, which are not shown here, are showing significant pessimism. So the conclusion which I would make is that despite some strength in the domestic economy by consumer confidence and consumer-driven growth possibility, the external challenges which we have been talking about earlier are likely to outpace this domestic strength, which can ultimately lead to a moderation in the emerging market outlook for the rest of the year.
Thank you very much, Abdul. So we are now going to move to the US, and in the US there is still optimism in large part. So if in 2016 both the global economy and the US economy started accelerating, it was kind of a combined acceleration. Now we are seeing some slowing in the rest of the world, but in the US the economic growth remains very strong. And the reason for that, or the reason why in the US it continues to be strong, whereas we're seeing slowing in the rest of the world, I think the main reason for that is the massive stimulus of the US government, both the tax cuts and the increased federal spending, which is also leading to very high business and consumer confidence. So we are expecting strong economic growth through the end of 2018 and perhaps early 2019. That is helping to significantly tighten the labor market. Job growth remains strong, although it is not accelerating. So we've seen acceleration in economic growth. In employment, it's more or less stayed the same. So the implication of that is that we're finally seeing some productivity growth accelerating. And labor market tightness, which is accelerating wages still moderately. But as we think about further down the road in 2019, it's hard for us to believe that the US can sustain 3+ GDP growth, 3+% GDP growth. We're seeing several factors that are likely to lower GDP growth closer to the trend of 2% during 2019. One of them is the potential risk from trade escalation, although that I think is a little lower now. Certainly with Europe and NAFTA, and there are less concerns, I think, than we had a couple of months ago. With China, there is still causes for concern. But in addition to that, in 2019, the large fiscal impact is likely to become smaller. Also, the Federal Reserve, concerned about inflation, is raising interest rate to slow down the economy, and they will probably succeed in that to some degree. Part of the strong growth we had in the US was a result of the overall strength in the global economy, which, as we discussed earlier, will slow down. So overall, we're expecting a strong growth for the rest of 2018, but during 2019, we are expecting to see some slowdown. So Brian, you're going to take us through some of the trends within that big picture.
My pleasure, Gad. So first of all, what's the baseline for why we expect such strong growth in the second half of 2018? At a very simple level, businesses are extraordinarily confident, as indicated by the green line, which is at its highest level in more than a decade, as are consumers. Our consumer confidence index also at its highest level in more than a decade, in fact, back to 2000. So the end result of that is when you have that strong business confidence, more investment, more spending from consumers when consumer confidence is high. And so combined with the fiscal stimulus, which is also contributing more now, especially from a government spending perspective, than it will in 2019, all of those factors are leading towards very strong growth during the second half of the year. We're expecting 3.7% growth. That's on top of 4.1% during the previous quarter. And a big part of that is going to be consumer spending. As consumer confidence has increased, spending growth has also remained very solid. We expect that to continue. One key thing, though, interpreting and thinking about the consumer confidence index right now, its impact on spending, is that the expectations component of our index, not shown here, but it has shown more of a flat trend than the overall consumer confidence index. And what that means is that consumers are not expecting the economy to strengthen further from these already strong growth figures that we've seen over the last year and a half, 2 years. And so you wouldn't expect an increase in spending. And indeed, getting out into 2019, as interest rates rise, as employment growth falls slightly, as you get less contribution from the fiscal stimulus, we would expect some slowdown in growth. In terms of big market indicators, first look at the S&P 500, which shows is just another measure showing how strong the business sector is right now. It has reached record highs after a brief wobble back in February and March, mostly as a result of the Cambridge Analytica situation. Equities have continued rising higher. That's a measure of corporate profit, showing the strength of corporate profits, and is a reflection of overall confidence in the present and future conditions of the US economy. Two key things that have occurred over the last few months is that oil prices have not risen higher. So even though we are concerned in the US about the financial market effects of a strengthening dollar, of higher oil prices on emerging markets, and how those effects could propagate themselves to other mature economies and indeed harm the fortunes of the US economy and inhibits its ability to outperform other global economies. Right now, oil prices are not increasing to the same extent they were earlier in the year. And part of that's a result of perceived slowing demand and slowing economic growth that Abdul described earlier. In addition to that, the uptick in the dollar, which was very strong from May through July, has not been quite as strong over the last 2 months or so. Fed policy will tighten and will likely result in higher exchange rates. However, for right now, sort of those concerns that we have about the effect of a strengthening dollar on emerging markets, those are not playing out to the same extent, and also that doesn't damage US competitiveness to quite the same extent. In terms of corporate profits, I think this is a very important part of the business confidence story, because you can see the blue line, not surprisingly, when the corporate tax cuts went into effect at the beginning of this year, dropping the primary rate from 35 to 21%. The end result of that is, of course, after-tax profits end up reaching a record high. But that's hardly surprising, given that if companies can keep more of their money, they will earn more in after-tax profits. What's even more encouraging is what's happening to the red line, the S&P's measure of total operating earnings, which reflects before tax profits. And that too is at record high levels. So businesses are earning more money, and not just because of tax cuts, that's also a matter of consumer demand. And that is helping. Some of those additional profits are being used to fund mergers and acquisition activities and stock buybacks. But in addition to that, we're also seeing an improvement in two key measures of investment. The blue line shows investment trends in capital equipment, which have reached a pretty strong growth trend of around 8% over the last few quarters. And that's, of course, encouraging from a productivity perspective. You provide more equipment to employees, they are able to produce more. Even more encouraging, in my view, from a productivity perspective, it's what's happening to intellectual property products, which includes research and development spending and software spending. The more spending in those two categories, and we're definitely seeing substantial growth there, the more that reflects a transition to new business models on the part of businesses, and which will result in some not just short-term but longer-term productivity gains. It's a hard series to forecast because there are some accounting peculiarities which can result in periods of growth that aren't necessarily in line with actual corporate spending, but it's definitely something to watch. Now, we do expect that next year some of that investment activity is going to slow down as the Federal Reserve raises interest rates and capital costs rise. However, for right now, the fact that equipment and intellectual property spending is growing is a very encouraging sign for the future of the US economy. taking a look at our forecast, you could see that growth this year is projected to be 3%. Next year is projected to be 3.1%. However, that does not mean 2019 is projected to be faster than a stronger year than 2018. What that reflects is that the last 3 quarters of 2018 are nearly averaging 4%. And so when you enter a year at that strong of a growth rate, the end result is that the next year, even if growth begins to slow, as we project, first half 2.9%, next year, second half 2.4%, the end result of that is that you still end up with a higher growth rate for the year, but we do expect, as we'll discuss in the second half of this program, that growth is going to slow during the second half of the year. A few numbers I want to draw your attention to. First of all, exports, you can see there was a very strong growth in the second quarter, but much of that was a result of fears that tariffs on soybeans would be put in place around the world to counteract some U.S. tariffs that had been imposed on steel and other items. So that resulted in unusually strong export growth. We expect that to be paid back in the third quarter, which is why you have that negative 1% growth figure there. And then also residential investment, I think, tells a very interesting story because we have seen a slackening in the housing market recently, and we'll talk more about that during the second half. But that is the one area of economic weakness, and that reflects labor shortages. It reflects increased material costs, and it reflects higher interest rates. Many of the stories that explain why we may see slower growth during the second half of the year.
Thanks, Brian. And so in the next several slides, we're going to talk about 2019. But again, before we tell you what we think, we would like to ask you a question, which is, how do you expect your firm's revenue levels in 2019 to compare to 2018? Higher, about the same, or lower? Again, your firm's US revenue levels 2019 to compare to 2018. Let's give it a few more seconds. 5, 4, 3, 2, 1. Okay, so 57% of you expect higher revenues, and the rest are about 24 and 19% about the same and lower. I'm actually a little surprised that it's not higher than 57%. I guess there are a larger share than I expected that are already expecting a lower revenue in 2019. Any thoughts, Brian?
But see, that's consistent with our overall outlook that you would expect actually more people to think that revenues will be the same or lower, simply because profitability and revenues were so high or have been so high in 2018. That's a difficult benchmark to cross. And actually, I mean, the figures we're seeing are very consistent with equity market valuations, which seem to believe that profits will just continue rising ad infinitum. But for right now, I think there's a lot of optimism, but I'm not sure those revenue projections are going to be borne out in 2019 simply because some of the constellation of factors that made 2018 such a good year will be in place in 2019, but some will not.
Well, there is a difference between profits and revenue. Profits, I do expect to see some slowdown but to actually have lower revenues in 2019, that means that there will be less demand, which is more unusual than to see a decline in profits. but perhaps there are some sectors where companies are pretty negative about. So let's look at, Brian, some of the key constraints and trends that we are expecting in 2019.
So I think we start with the baseline, extraordinarily high confidence leading into the year. But there are factors that could slow growth during the course of the year. We've mentioned the emerging markets and how those risks could propagate and slow down the US economy simply because they'll spread to other emerging markets, spread to mature economies, create more financial instability. None of that is good for investment appetites. There's also likely to be some more upward pressure on the inflation front. Wages are showing more signs of acceleration. Certainly the labor market is extraordinarily tight right now by just about any measure you want to look at. And on the one hand, that's very good news for consumption. On the other hand, that raises firm costs. And in addition to that, that's going to result in the Federal Reserve raising interest rates more quickly, which is going to raise capital costs for consumers, for home buyers, and for firms looking to invest more. So all of those things are going to make the cost of obtaining financing higher. And as a result, some of that activity associated with said financing will be lower. There's also going to be some industry-specific supply constraints. Two that we'll talk about are transportation and housing. Trade policy, even though a NAFTA deal appears closer, there's still a tremendous amount of uncertainty regarding the US-China trade relationship, and that could play a role in shaping 2019's outlook. And then in addition to that, there's going to be less support coming from fiscal policy. We will see at the beginning of the year some additional consumption as a result of the individual tax cuts as individuals receive their refunds. However, some of the increase in government spending, that's going to ebb by the end of the year. And then what's going to be key in trying to keep up this current very high rate of growth is what happens to productivity. There's only so much labor supply. There's not going to be further acceleration in employment growth. So the only way businesses are going to be able to produce more and grow revenues at the same rates is by getting more out of their workers, by equipping them with more technology, and that's going to mean productivity growth. So Gad, what is happening right now in the labor market? What evidence do we have that a tight labor market, how tight is the labor market, and what evidence do we have that that labor market tightness is translating into increased wage growth?
Yeah, no, there is mounting evidence about the tightening labor market. The unemployment rate is close to the lowest we had since the 1960s. Other measures of labor market tightness are also pointing that we are already in a tighter labor market than we had in 2007. Quits rate, which is or labor turnover, which is an important indicator of labor market tightness, is also accelerating. It's already, we see more people quitting their jobs than in 2007. And we are starting to see more acceleration in wages. There are two measures here. In both of them are showing in recent months more acceleration. Still below 2007 rates, but the direction is up. We're especially seeing faster wage growth in blue-collar and low-paid services jobs. So their labor markets are tighter. We're actually coming out with a report on that in October, probably. This, I think, is one of the less documented and important trends in the US economy, that in the past, white-collar jobs usually had tighter labor markets, and faster wage growth, but that is changing. In the past couple of years, we're seeing faster wage growth for blue-collar and low-paid services. It's across the board, but especially where we're seeing it strong is in transportation. A severe, almost unprecedented shortage of drivers that is having an impact on wages and prices, as we'll show later. So we're seeing it very much already in the blue-collar sector, and in the white-collar, it's still, I would say, a mild labor market tightness. But as the working age population is barely growing at all, we're likely, and strong economy continuing, we're likely to see further tightening in every part of the economy. And the main reason for that is employment growth. When employment growth, as it's been growing at about 200,000 new jobs every month, that's 2.4 million jobs a year. When the labor market is already tight and working age population is barely growing at all, this strong economic growth is certain to continue to tighten the labor market. And a year from now, where we're still expecting very strong growth, the labor market will be significantly more tight than we're seeing now, with implications for recruiting difficulties, for implications for labor turnover, and implication for wages.
Right, and what this chart also illustrates is that even though the labor market is tight, until our leading index starts going down, signaling that recession is on the horizon, as you could see in the late 90s, you don't see a decline in employment growth until later. So even though that labor market is tight, we don't expect for employment growth to slow. And that's going to help out with consumption, especially because, as Gad says, blue-collar workers are making more money, and those consumers have a greater propensity to consume. So that's going to help support demand. But all of that demand also ends up boosting inflation risk. The blue line shows the Federal Reserve's preferred measure of inflation. That's reaching a 2% target for the first time since 2012. And what that means is that the Federal Reserve is likely to boost interest rates twice this year, more this year, 3 more times next year, higher capital costs. Markets, as shown by the 5-year measure of inflation expectations shown in the green line, do expect the Fed to successfully be able to control inflation overall, but that may not be true in every sector. So I think there are some critical industry-specific supply constraints that could hamper growth next year. One of these is in the transportation and warehousing of goods, where despite a decline in costs reported this morning, those costs are still expanding at a 6.4% year-over-year rate. And what that means is that as a result of supply constraints in terms of the number of truck drivers available, the amount of transportation warehouse facilities available, cost pressures both from a labor perspective and simply a capacity perspective are rising. And when transportation and warehousing of goods cost rises, that's going to affect many, many sectors of the economy, making them less profitable, forcing up prices in many of those sectors, and making companies across the economy somewhat less competitive. So I think those costs are definitely an area to watch out for next year. Another area where we're seeing the impact of supply constraints is in housing. First of all, looking at the red line, which shows growth in housing starts. Housing starts have been declining since the beginning of the year. That's the one negative spot in terms of economic developments this year. And there are a few reasons for that. Higher interest rates do nothing to boost housing demand. That goes without saying. The job vacancy rate for construction workers has been rising and is now at its highest level this cycle, and indeed is at its highest level in some time. And then in addition, material and component prices for construction have been rising. Part of that is a result of tariff disputes with Canada, soft and hardwood lumber prices. But part of that is also just the sheer amount of demand on building materials, which drives up prices. So all of those factors are combining to reduce demand for housing. Another area where the economy is going to receive considerably less support in 2019 and in 2018 is from fiscal stimulus, both in terms of tax cuts and government spending. First of all, from a tax cut perspective, individuals and pass-through businesses are going to receive their refund checks early next year. So that's going to help boost their level of spending. But at the same time, you're not going to see additional spending directly associated with the corporate tax cuts, because those have been realized this year. The wealth effects associated with those and rising equity prices associated with those have been realized this year already. So the extent to which the tax cuts are going to directly affect economic growth is going to be less next year. However, of course, and to the extent corporate tax cuts are driving higher levels of investment and individual tax cuts have so far supported demand, some of those gains will remain in place going into 2019. In terms of federal spending, we saw a big increase in federal spending announced at the beginning of this year. That spending is spread across many, many agencies, federal agencies, with healthcare and defense consuming a particularly large chunk of that. It does take time for those agencies to get that spending online. However, as they do, what ends up happening is that you'll see federal spending growth reach its peak, I think, in around the fourth quarter of this year, and then it's going to tail off during the year into 2019. So that's going to be another area that's not going to be as supportive of growth in 2019 compared with 2018. And we could see what markets are expecting in terms of future demand for capital based on what's happening to 2- and 10-year Treasury yields, because that's one way of assessing relative expectations about future borrowing conditions. So on the 2-year, we've seen a large substantial increase going to the present day. The 10-year has seen more of a flattening trend recently. So this brings up fears of an inverted yield curve, which in past episodes has been a signal of recession simply because it means that markets do not expect long-term borrowing and long-term economic activity to be quite as strong as they are in the short term. However, it typically takes about a year for an inversion in the yield curve to translate itself into a recession. So even if that does happen, I would not expect that to happen until maybe the beginning of 2019. And even if it does, that wouldn't result in higher recession risks necessarily in 2019, but it is a sign that expectations related to CapEx may be slower in 2019 relative to 2018. And then finally, I think productivity is a really good place to end this discussion, because employment growth, as we've mentioned, can only increase. It's going to, if anything, slow in 2019. It's not going to halt, but it's certainly going to slow. And so what that is going to mean is that in order to maintain a faster growth trajectory, in order not to have this gradual slowdown, down as far as 2.3% by the fourth quarter of next year, according to our forecast, what needs to happen is for employers to be able to produce more with the same number of their workers. And indeed, we've seen that productivity in terms of the 6-year annualized change, the thick blue line, has been trending downward over time, really going back to the dot-com boom. However, if you look at what's happened more recently from a 4-quarter perspective, the dotted line, you could see that we've gone from negative productivity growth back in the middle parts of 2016 to now an uptick in productivity growth in 2018, not to near the levels that we saw back from that 1996 to 2004 period, but certainly stronger productivity growth, and that's particularly true in the second quarter of 2018, where there was an uptick in productivity growth. And the question is going to be, can that uptick be sustained? Will the way in which capital is being allocated as a result of the tax cut, as a result of business optimism, is that going to be able to sustain longer-term growth? Because further fiscal stimulus, both tax cuts and additional government spending, is unlikely. The labor market can only contribute so much, and beyond 2019, I think employment growth is almost going to have to slow it because unemployment rates will simply be too low. Employment to population ratios by age group will be at a similar level to where they were before the Great Recession. So the extent to which the labor force can grow further is going to be limited. So it's going to be a question of whether this current increase in investment leads to more innovation and more productivity. And that's what's going to determine the outlook for 2019 and beyond.
Thank you very much, Brian. So we are close to concluding our webcast. I just want to remind you of a few future webcasts and reports that we're going to have. So as usual, next month we'll have the Economics Watch and the whole suite of deliverables that come with that. The focus of the next month's Economics Watch will be a report that we're going to come out with right before the webcast. It's called Beyond the Hype, Non-Traditional Working Arrangements and Platforms. As you can tell by the name, we think that some of the excitement about labor market platforms and in general the usage of non-traditional workers is a hype, but you'll hear more from us about that next month. There are a few reports that I think are worth mentioning. One is a straight talk about the global economic outlook, and we just released a month ago our less than a month, our job satisfaction, the annual job satisfaction report. We're seeing 7th year in a row we're seeing a growth in job satisfaction, and not surprisingly, it is especially concentrated in low-income households, partly because we are seeing a stronger labor market for blue-collar and low-paid services workers. And if you have a minute to provide us with some feedback, we'd be very appreciative of that. I want to thank Brian and Abdul for joining me today in this webcast, and I hope to see you soon in future webcasts. Thank you and goodbye.